With the new financial year starting soon on April the 6th, I wanted to put a video together covering all the things that everyone should do before this date. I think there's at least one thing here that you might not have thought about before, and I'm sure that some people will be able to save thousands, if not much more. Anyway, getting straight into number one, which is one of my absolute favourite topics, let's talk about ISA allowances. So every tax year, each adult in the UK has an allowance of money that they are allowed to contribute into their ISA accounts. Now this stands for individual savings accounts and includes things like your cash ISA, your stocks and shares ISA, and your lifetime ISA. What is really important here is that your £20,000 allowance resets at the start of every tax year, and you cannot get it back once it's gone. It's use it or lose it. Now, this amount of money is really generous, and most people will be nowhere near being able to use their maximum allowances. However, there will be people out there who still do not really know how ISAs work. Now, I've done a more in-depth guide on another video covering all the details, but for now, let me just remind you of how these things actually work. The key thing to note here, and the reason why these types of accounts are so good, is that any gains you make inside of them are completely tax-free. You will not have to pay capital gains taxes, dividends taxes, or any taxes on your savings when it comes to selling or withdrawing your money. In the long run, this can make a huge difference to how much you end up with, and it's vital that you understand the basics of how they work. So in short, these ISA accounts are just that. They are types of accounts. What you do with them will depend on the type of account you use and what you choose to put in them. So for example, a cash ISA is designed to be an account where you save cash and get a fixed rate of interest. Millions of people in the UK have one of these. They're nice and simple to understand, nothing too complicated here. On the other hand, accounts like a stocks and shares ISA and the lifetime ISA are a bit more complicated. The stocks and shares ISA allows you to invest in the stock market and buy shares in companies from all over the world. And the lifetime ISA is an account that gets even more complicated, as you can have a cash version or a stocks version, and it's got a few more restrictions too. However, without going into too much detail, the point I really wanted to make in this video was that your allowances get reset in the new tax year. So think long and hard about what you can do now. For example, you might have cash in a regular savings account or sitting in your bank account earning no interest. Or you could have some investments in a general investing account, which could be liable to tax in the long run. If you have the allowances left, I'd think about using these and getting that money into these types of accounts, as this protects the money from tax in the future. What's really important to note here too is that you can freely transfer money between the different ISA accounts and keep them tax-free. So let's say that you add £5,000 into a cash ISA before the new tax year, just to make sure that you use your allowance. You can then move this to a stocks and shares ISA easily enough when we go into the new tax year. Some platforms even let you do it all simply in one place. Now, as a quick example, one app that I use, Trading212, lets you move money between your different accounts and ISAs in just a couple of clicks. They also offer a free stocks and shares ISA account as well as a cash ISA. Now, if you're looking for a place to get started, you can open a stocks and shares ISA account, deposit just £1 and get a free fractional share worth up to £100 to get yourself started. I also use other platforms, and I've done a much more in-depth guide to these in a separate video, so feel free to check that one out later. Now, one final tip I want to leave you here is this one. If you're lucky enough to have used up your whole ISA allowance of £20,000 already this tax year, don't forget to work together with your partner or other half to use theirs too. We all get the same allowance no matter how much we earn, and it's got nothing to do with whether we're employed or not. It's just another reason why the ISA is just such a powerful type of account. Use it or lose it. Okay, the second most important thing we all need to do is look at our pensions. Now, I know this is probably the most hated topic in all personal finance because it can get so complicated and it sounds so boring. But I know there'll be so many people out there who could save themselves an absolute fortune and be way better off if they just spent a tiny bit of time understanding a few basic things. So here's what I would say we all need to know. And obviously there's always more detail than I can ever cover in one single video. The key things are this. Each tax year, you can put up to £60,000 into your pension or up to 100% of your income, whichever is the lowest amount. Now, this includes a basic rate of tax relief, meaning that between you and your employer, if you do have a job, you can contribute up to £48,000 with the additional £12,000 being added as a tax relief by HMRC. Now, I know that most people won't earn anywhere near this amount, so you don't have to concern yourself with those limits, and do note that super high earners get an even lower allowance. However, as income tax bans have been frozen for so long, more and more people are finding themselves creeping into that higher rate of income tax. For every pound you earn above £50,270, you will pay 40% in income tax. And then once you hit £125,140, every pound above this gets hit with 45%. Now here's where pensions come into this. If you've been a higher rate taxpayer earning anything above £50,270, you could be able to claim back tax relief on contributions made into your pensions. This tax relief will get paid directly into your bank account, and there is estimated to be about £1.3 billion worth of relief that is left unclaimed. So to keep things simple, here's what I think you should do if you're a higher rate taxpayer now or you have been for the last few years. Firstly, check with your employer to see how your pension contributions get taken out of your pay. If they come out before tax, then you're fine, you don't need to do anything here, and you've already received the relevant tax relief automatically. However, if your pension contributions have been coming out after taxation, then you might be able to claim back your relief. You're the only one who's responsible for doing this, and nobody is going to do it for you or give it to you automatically. There's a few ways of doing it, and I'll leave the link to the HMRC website in the description below. They have actually made it easier than it was before. Also, you can go back and claim this relief from the last 4 tax years. So this could end up being quite a lot of money for some people. Now, I'd love to hear from you if you've done this before or you end up doing it. One final little tip on pensions is also the fact that you can backdate pension contributions if you ever find yourself with lots of cash to use now. For example, if you're set to max out your contribution this tax year, you're allowed to go back up to 4 tax years and make top-ups. There's more details like being a member of a pension scheme, and if you are ever unsure of any of those things, please do double check everything with your accountant or a financial advisor. I'm not either of those things and never claim to be. Anyway, there's loads more I'd love to cover in this video about pensions, but you'll find a lot more in other videos in the future and ones already on my channel. Next up, let's cover 3 different allowances and we'll go through these ones fairly quickly. Firstly, we have the savings allowance. Now, if you weren't already aware, most of us have an amount of interest that we can receive from our savings without having to pay any tax at all. Now, this ranges from £1,000 for basic rate taxpayers, £500 for higher rate taxpayers, and then nothing at all for additional rate taxpayers. Now, this can be useful if you've not got your savings inside accounts like an ISA or maybe something like premium bonds where you'd pay no tax at all anyway. Now, more people are being caught out by this as interest rates have been going up, so it's worth paying attention in case you find yourself with a lot of spare cash making interest. For some perspective, if you were to make 5% a year in savings interest on £20,000, you'd earn £1,000 in that year. And if you were a higher rate taxpayer, you'd be liable to pay tax on £500 of that. The tax rates are the same as your income tax band, so that could end up being a lot of money. Now, one final thing on savings is that there is actually something called the starting rate, which could mean you're eligible to have up to £5,000 in interest tax-free. Now, this is for anyone earning under £12,570, and it tapers by £1 for every pound that you make between £12,570 and £17,570. So if you are a low income but you have a huge amount in savings, there is actually a bit of a break for you here. Now, as with all of these allowances, it resets each tax year. Next up, let's talk about the dividend allowance. Now, if you run a business or you own shares in a company on the stock market, you'll probably want to receive a dividend at some point. Every tax year you get an allowance, and this tax year the allowance is just £500, where it used to be £2,000 just a couple of years ago. You can only earn £500 in dividends before you are liable to pay tax, which depends on which income tax band you fall into. It can be anything from 8.75% to 39.35%. Now, this allowance is worth highlighting because just like the other taxes, it can all be avoided if you hold your investments inside an ISA or a pension. Dividends don't get taxed if they're inside those tax protected accounts. So this means that you don't have to worry about trying to work out what you might be liable to pay. Hopefully this video is a bit of a reminder for some people to go and see if they're able to move some investments from a general investing account to an ISA or a pension to protect themselves from tax on their dividends. With the allowance being just £500, there are way more people who will fall into this trap when compared to just a couple of years ago. Now just think, a portfolio of £10,000 with a 5% dividend yield is already £500. So any money on top of that is going to be liable to tax. Try and be smart about it if you can, but at least it does reset every single tax year. In previous years, you could have made the argument that it was fine to have investments outside of an ISA paying you dividends as you had that nice allowance, but Those days are now long gone. Leading on from that one, the next allowance is very similar, and that is capital gains allowances. If you sell an asset and make a profit from something, whether that's a share in a business, cryptocurrency, or a buy-to-let property, you may have to pay tax on it. So for example, if you've bought some shares for £5,000 and then a few years later they're now worth £15,000 and you sell them, you've made a profit of £10,000, which would be called a capital gain. We all get a capital gains allowance of £3,000 each tax year. So in this example, you would only need to pay tax on £7,000 of that £10,000 gain. Now, just like the dividends allowance, the capital gains allowance has been cut massively from where it was a couple of years ago, from £12,300. So just like before, more and more people are falling into the trap of paying this tax, unaware that they could avoid it entirely. In the most recent government budget, the rates for capital gains tax have now been raised so that basic rate taxpayers pay 18%, and a higher rate taxpayer will pay 24%. The solution here is the same as the last allowance, and it applies to all of them really. Do whatever you can to hold assets inside of a tax-efficient account, those accounts being things like ISAs and pensions. Now, there's not much you can do if you're selling a startup for millions of pounds, but if you're selling shares that you've bought in a general investing account, yet again, make sure you're using ISAs and pensions. I think for the vast majority of people out there, and for most of you watching my videos, there should be no reason you should be paying capital gains taxes on your investments if you've not already maxed out your ISAs and pension allowances. Anyway, have a look at it if it applies to you and take the time before April the 6th to use your allowance. Otherwise, yet again, it's use it or lose it. Now, the final thing all of us need to check before the new tax year is something that could have a huge effect on our future. If you weren't already aware, at the end of this tax year, the government is putting a limit on how many years you can go back and pay to top up your national insurance record. Now, this record is directly tied to when you can be eligible for the full state pension, and you currently need 35 completed years to get this benefit. Now, at the moment, you can go back and plug gaps by paying money to any year as far back as 2006. In the next tax year, this is changing so that you can only ever go back and pay within the last 6 years. Now, I know this is not the most exciting topic, and it's probably something none of us think about, but I do think that this is something we should all check, even if we don't end up actually having to do anything. You can easily check all your previous years on the HMRC website. I'll put a link to this in the description for you all. If you find a gap in your record, or you find there was a year when you were out of work for whatever reason, you might decide that it's a great investment to pay for that year. If you want a useful guide to help go through all of the details and help you decide whether or not you need to top up your national insurance record, I'm going to leave a link to James Shack's really useful video that he did just a few weeks ago on this topic, as I think it deserves more than just a quick mention here. Now, if you watch that, you'll be in a much better position to know what to do now. Just on a final note on this topic, I did see this article on the BBC News website that says the deadline is not a hard one. And if you do need a call back from HMRC and you ask for it before the deadline, then you can still go back and buy previous years up until 2006. It just says you need to request a call on their callback service, so don't panic too much as those phone lines get clogged up by people trying to see what they need to do. Anyway, I hope you found that video useful. Make sure you're up to date before the new financial year ticks over. And also, feel free to comment below if there's anything else that I've missed or you think anything else that's worth doing. I'll see you in the next video. As always, happy investing.